It was another whipsaw week on Wall Street as the market reacted to inflation news, recession fears, impending rate hikes from the Fed. Yuck. Where should investors put their money? Joining me now, the head of U.S. equity and quantitative strategy at Bank of America Securities, Savita Subramanian. Savita, let's start with the sell-off this past week. Is this the beginning of another leg down for stocks, or should investors be buying here?
Yeah, I mean, I think that in terms of finding a market bottom, it's a tough question. I don't think we should be buying stocks wholesale right now. I think there could be more volatility as we digest, the positive surprises to the inflation data, the idea that all these supply chain risks are not necessarily over yet, the idea that the Fed might even be more aggressive than the aggressive Fed we're penciling in today. So I think the idea today is to be selective, because there are obviously a lot of stocks that have dropped by a precipitous amount and are great buying opportunities. So what I would do is basically sift through the rubble and look for companies with visible earnings streams, low coverage or low leverage ratios, high ability to increase their dividends, and some gearing towards inflation, because the good news about stocks is that earnings are nominal, and unlike bond yields, they grow with inflation in many sectors. So the areas we like today are energy, obviously great inflation play, financials, more of the cyclical areas of the market, but consumer stocks are typically hurt rather than helped by inflation, so we would stay away.
And you've said that factors are more meaningful than sectors. What do you mean by that? And are the factors you would look for some of the ones you just mentioned?
Yeah, absolutely. So factors, the way we think about this in quant land is, instead of picking sectors, which are kind of arbitrarily defined as, consumer stocks, but they can be autos or retailers, which all behave very differently. Factors are really looking for attributes like free cash flow yield or, duration. If you pay today, how long does it take to recover your investment? So those are some of the areas where we found they're much more well-behaved during periods of rising interest rates or rising cash yields. Today, if you think about what's happening, the Fed is basically moving cash from zero or worthless to 3-4% yields over a very short period of time. So one of my favorite factors or ways to screen for stocks is looking for high free cash flow to low enterprise value or low firm value. And I think that's really the way to think about finding good stock ideas in an environment where we've had a lot of derating, but we're still at a point where inflation is going to continue to be a risk, rising rates may continue to be a risk, and we're really moving off of the grid in terms of an environment of super low cost of capital, easy monetary policy, globalization, everything we could have dreamed for, to a tougher slog, if you will.
The big cap growth stocks, those were the winners for years before the Fed started hiking. And you say it's time now to prefer small caps. Why is that?
So small caps are an interesting cohort, and I think they're really sort of the opposite of what has done well over the last 10 years. So if you think about it, we've had this disruptive, disinflationary environment where oligopolistic themes, share gainers, disruptors, technology, mega cap tech really, kind of led the market. Today, when you look at the small cap value area, it's really a lot of these companies that were, that are more cyclical, and we haven't really had a strong economic recovery, and that benefit from higher U.S. GDP growth. Now, when I look at what companies are telling us they're going to do, a lot of these big global companies are rejiggering their supply chains and moving them back to the U.S. What does that mean? Well, it means that we're in for a real CapEx cycle after many, many years of corporates underinvesting. And it also means that U.S. GDP growth is probably going to be better than rest of world GDP growth. So in that environment, we think that smaller companies could benefit, like they typically do, from these big CapEx cycles. Furthermore, when you look at the valuation of small caps, they're trading dirt cheap today. I mean, they're trading at sort of a record discount to large caps, where they typically trade at a premium. So our view is that they're pricing in more recession and downturn risk than the larger cap companies.
We've got about 15 seconds. Energy stocks up a lot. Is it still a good idea to buy energy stocks, or is there some better way to get energy exposure like industrials?
Buy buy energy outright. Nobody owns energy outright. The question we get from clients is, how can we own energy without owning energy? Energy is still 30% underweight in the average mutual fund. We think the pain trade is up.
Savita, always nice speaking with you. Thank you.
Likewise.